Dear friends, we have discussed all the capital budgeting adjustments, how to calculate the new product line or new project incremental earnings, then how to make the minimum adjustments like adding depreciation, deducting the capital expenditure, adjusting the working capital increment in the working capital requirement or change in the working capital requirement, getting the free cash flow, then some externalities like a profit from sale of the scrap or maybe doing some kind of other adjustments. We have calculated all these kind of project externalities like cannibalization, all these things we have discussed till now. Here the last part of this discussion will talk about, of course, you see here I am not putting importance on the methods of capital budgeting. The methods of capital budgeting you have learned in your earlier courses like 501 and all, like the NPV, IRR, payback period, XNPV, XIRR. Of course, in the last part, I can explain you in very maybe in the spreadsheet calculations we can discuss in one part we can make. But here uh, the special treatment of capital budgeting we are discussing. We are not discussing the methods here. Methods are discussed in the previous chapter. But here in this course, we will take the capital budgeting special categories or special criteria like how to calculate free cash flow, how to calculate the incremental earnings, how to adjust the project externalities. We have done all this kind of analysis. Now the last part is doing the sensitivity and scenario analysis. You know, in the Cisco project, the wireless router project, so basically, this is giving you very good kind of net present value. If anyone sees this, very attractive. If you are investing in this project, the capital investment is only 7.5 million. That is the testing equipment. Rest all are the variable expenditures like the cost of goods sold. You are outsourcing, only spending 7.5 million for setting up a lab for testing the quality of the routers. Otherwise, 7.5 million you are spending, but your NPV is 2.862 million. Very good. But we have not taken any kind of sensitivity or scenarios here. See, the scenario can be a worst scenario. See, for example, 2020. For say this project has been accepted in January 2019, thinking all these kind of sales of everything. In 2020, might be the sales increased. Why? This is a Wi-Fi net router. You know, in 2020 and 2021, we are doing everything through Wi-Fi, through internet enabled. So the sale of this product will be much higher than the expectation. We only expected 50,000, but it might be 60, it might be 100,000 because in 2020 everything work from home, the things are all the classes we are taking online. So things are we never expected. Even Cisco never expected. So the thing is, what happens if worst scenario, what happens is best scenario, what happens economy going in favor of you, all these things we will consider in the sensitivity analysis. We will change the sales, we will change the cost, we will change both, we will change the demand, everything we will do because we are talking about financial modeling. In the modeling we can do all these things very easily and very comfortably. Let us do it. Here the first, the first scenario or the sensitivity is being provided to you. There is a thin line of difference between sensitivity and scenario. One is changing one, the other one is changing all. If the scenario changes, many inputs will be changed. Sensitivity means changing only one variable, you are seeing the result. One or two variable or few of the variables you change, then it becomes you find the sensitivity of this change in the result. So here, for example, the sensitivity is being done. You are expecting normal initial assumption, you have taken 50,000. What happens? Worst case will come and your sales will become 35,000 unit. What happens? There will be a best scenario like in 2020 your sales increase to 65,000. Next sensitivity will be you assume $260 as a unit selling price. But if the scenario becomes worst, you have to reduce the price to 240. If the price becomes 240, what happens? If the price becomes 280, what happens? Next sensitivity issue is cost of goods sold. The cost per unit, you will outsource it and it will be 110 per unit. The third party will charge you 110 to provide one router. But what if the cost becomes worst case scenario will be increasing the cost 120 per unit. In best scenario, your sales is increasing, so the vendor will say, okay, I will supply at 100. Net working capital requirement, you have thought for 1125 thousands or 1.125 million. What if the working capital requirement will be 1.525 million? What if in best scenario 725,000? You assumed cost of capital 12%. What if the cost of capital is 15% in worst scenario or 10% in best scenario? If you can see all this sensitivity, and you asked a question before we start this discussion. Is it farm specific or it is common? It is like depends on the manager who is doing such kind of estimation. The more you go detailed, the more detailed analysis you will have. And one of you said probably you will become the CFO. So kind of the more you became foresee the future, the more detailed analysis you do, the more sensitivity you will provide. The shareholder, the director, the CEO, the CFO, they will be more happier because they will be very clear. Okay, if things goes bad also, my what will be my scenario? If the worst case comes also, see, you assumed 50,000 will be sold, 260 per unit will be selling price, 110 will be cost price, 1125 working capital requirement, 1.125 million is the working capital, cost of capital 12%. If worst scenario comes, okay, my sales will be 35,000, sell price will be 240, cost of goods will be 120 per unit, working capital will increase to 1.525 million, cost of capital increase to 15%. What will be the output? If best scenario comes, what will be my output? If you provide, then it becomes a very interesting kind of observation. You see, if best scenario, then your green line, the green zone will be your profitability and your net present value will go up. The one is 65,000, the other one is 35,000. Was original 50 you have assumed. The middle line is the original one. The right side is the best case scenario. And the left side is the worst case scenario. If it is best scenario, 65,000 you will sell. Worst scenario, 35,000 you will sell. If best scenario, then selling price will increase to 280. Worst scenario, it will become 240. Best scenario, cost will go down to 100. Worst, it will go up 120. Similarly, all these things, how we show this, how we will find the break even. Break even is equal to units sold multiplied by sale minus cost per unit minus this GA minus depreciation will be the 0, because the break even unit is the break even is the number of units at which you book no profit, no loss. So break even unit will be the unit at which your units sold multiplied by sales per unit minus cost per unit minus SGA and minus depreciation will be 0. The unit will be, number of unit will be the break even. And the formula will be fixed cost divided by sales minus variable cost will be the break-even point. And this is the break-even based on the unit sold. The 40,000 will be the break-even, or less than 40,000 will be the break-even units. See, little less than 40,000 will be the number of units at which your profit or loss will be zero. No profit, no loss. And break-even based on the cost of goods sold, 141 or something like that, 142 will be the cost of goods sold at which you will get the break-even. And that provides you, there is a very good tool called data table where you get the break even. You see here, for example, you see here original selling price, for example, $3, units sold is 15,000, revenue will be 45,000, cost per unit is equal to 1, variable cost is 15,000, fixed cost will be 20,000, profit will be equal to 10,000, right? And break even point will be equal to 10,000 units. You know, I told you break even point is equal to sales minus fixed cost divided by sales minus variable cost. Fixed cost is B18 here, that is equal to 20,000 divided by sales. Sales is $3 per unit minus variable cost is $1 per unit will be the break even point. So different now, for example, this is the baseline calculation. Now profit or loss will be zero, changing the price. How you do it? Say for example, go to the goal sake. Okay, the value you want how much? I need 0. By changing cell, which one? By which one you want to change to make your profit to be 0? Tell me which one you want to change. Tell me here, I will change that. Original is, see the original one. Original is selling price is $3, units sold 15,000, revenue 45,000, cost per unit will be 1. Then the profit will be 10,000 unit. For example, I want my profit to be 0. I want to find my 0 profit. When is my 0 profit? By changing, for example, the selling price. Enter. Okay. Okay. 2.33. For example, same. Gulsek C19. I will change the value, for example, units sold to value 0. Okay. Units sold how much? For example, this I want to change. Say for example, my selling price will be 2.33. Okay. Now come here. Come here. Go to the what if and how much I need the profit? It is, I have calculated 10,000. You tell me one figure. Anyone? For example, 20,000. Make it. 20,000. What will be my, I want my profit to be 20,000. By changing what? By changing the selling price. Enter. Okay. If my selling price will be 3.67, then my profit will be 20,000. Okay. For example, I will make it 20,000 or make it 10,000 by changing the units sold. Okay. See, with this 3.67, all these are, let us go for home. Okay. So by making 3.67 as the selling price, if I want 10,000, then my number of units to be sold is 11,250. But here, for making zero profit, if I want to sell 15,000 at 2.33, my profit will be zero. Similarly, goal seek will make anything you want to change. One by one, I have taken here cost per unit, for example. Oh, I was talking about data table all the times. I was telling you data table. Now we are talking about goal seek, where you see, for example, you want your profit to be, for example, 50,000, and you want to change this. You want to, when I can get 50,000 profit. Now in the existing calculation, profit is 10,000, selling price is 3, unit sold is 15,000, revenue and cost price is 1. When I can make my profit 10,000 should be 50,000, changing the, for example, the the variable cost. Okay. See, it is not at all possible. Minus, it is going to minus. So cancel. What I will do now, I will make the profit, for example, 20,000. It is there 10,000. I want to make it 20,000 by changing the variable cost. Okay. If the variable cost becomes 33 halala instead of 1 real, then you can have this kind of, say, okay. So if the cost becomes 33 halala, then my profit will be doubled. This is the way we make the analysis. One of the analysis is being done for making the break-even point. Here only two are explained. Only the sales is explained and cost is explained. We have discussed sales, selling price, cost price. Even you can change variable cost. We have changed the variable cost. We can do the fixed cost. All these things we can change. We can calculate the break-even point. Why? Break-even point is the zero profit, zero loss zone. Say, for example, we can do that here. Whichever you see, one by one, there only sales and cost is being taken. For example, here is the, what will be the selling price when you will get the break-even profit to be zero. 2.33 which should be the selling price. Then your break-even point with the existing kind of thing will be zero. Similarly, for example, here changing the units sold. Units sold, for example, you go here and it should be, because break even means zero, by changing what? Units sold. Units sold here, enter. So if you sell 7,500 unit, okay. If you sell 7,500 unit at the 3.67 price, you will get zero. So here we are doing the scenario sensitivity. Many inputs we changed. Here see, input is 350. Original is nowhere we are maintaining. Here it is 2.33. Changed it and it becomes zero. Here it become the selling price also changed. Unit sold also changed, and break even is calculated. And you can see many more things you can change and calculate the break even point. Then we will go to the scenario analysis. For the scenario analysis, it is being explained. 2 to 3 different scenarios are being done. How? 2 scenarios are being done here. Strategy 2 multiplied by 3. 6 different things we are changing. How? Originally, we have assumed 260 selling price, 50,000 units to be sold, and our NPV was 2.862 million. 50,000 sold, 260 selling price, our NPV is 2.862 million. All right, clear? This is the original baseline assumption. Now we are changing 4 things. What are they? What if our price becomes 245 and units sold is 55,000. Your NPV will become 2.729 million. What if your price becomes 275 and your units sold is 45,000? Your NPV still remains 2.729 million. What if the selling price is 300, units sold is 60,000? You have to calculate. Manually, you can do 2-3 changes, but spreadsheet makes all these calculation here. See, this is the baseline what the presentation is taking here: 260, 245, 275, 50, 55, 45. How would you do that? I'm deleting what we have calculated originally. We only give the input here. Input is what? Remember the input, please. 260, 245, 275. These are the selling price. 260, 245, 275. Baseline, we have first tried to answer what the presentation is talking about. Next is 50,000, sorry, 50,000, 55,000 and 45,000. So 50,000, 55,000 and 45,000. We want to calculate the different NPVs available. What we will do here, we will calculate this is equal to the, first of all, let me show you the changes. Sorry. Here, yeah. See, now, okay, that I've made it white to give you a strategy. I'll explain you how, why. So you understand the input is 260, 245, 275 per unit. What if the input is 50,000, 55,000, 45,000? What if 50,000 sales? Originally we assumed 55,000, 45,000. Increased 5,000, decreased 5,000. First is equal to, you show the NPV you have calculated here. What you want? Here we want to show the NPV. So show the NPV here. Right? Next is enter. What happens? NPV is 286,2081 in the original scenario. What is the original scenario? 50,000, $260. We want to fill the other scenarios. All the other places we want to fill. How we do that? Select the range of data. Then go to the data and what if analysis, you go to the data table. Okay, it's asking you in the row what you want to change. In the row what we have changed, in the row we have shown the selling price. So go to the input area where from you got the input, select that. So in the row we have given the selling price. And in the column what you have given? In the column we have given the number of units. This is what if we have given. So the number of units in the column we have given. So enter. You see down? 286,2081. And once you do that, this one you make magic. Magic means what? You disable the, for example, the color. There will be no fill and the number. So no one will understand you have given a formula here. And it becomes a, now if the price becomes 260, unit become 50,000, the NPV will be 2.86 million. If price is 260, units sold is 55,000, NPV will become 4.19 million. Remember, simply what you have done here, same price, only 5,000 unit you sold more. Original assumption is 50,000, new assumption is 55,000. See the NPV change, 4.19 million, almost 2 million increased, or 1.5 million increase. And 260 original price, 45,000, number of sold, 1.53 million NPV. 245 selling price, 50,000, then 1.53 million NPV. 55,000, 245, 2.72 million. So these are the three answers given in the slide here. You can see the slide here, 2.862, 2.729, 2.729. But how many probabilities we get other than these three? Another 6, because it's a 3 into 3 matrix. So all these things you got it. Now what I will do, little magic I will change here. This is equal to, first of all change the colors and all. Black and yellow. See, this became black or maybe red. So I deleted everything from here. What I will put here, I will put, see, once I delete, the data table becomes 0 now. What I will put here, I will put the IRR. We have calculated IRR here. Enter this. This is equal to IRR. Enter. You see now, all percentages I calculate here. See, if for example, my original scenario is 260, 50,000. IRR is 26.56%. We calculated here 26.56%. Where is that? Yeah, 26.56%. If I change 245, 50,000, my IRR will be 19.96%. See how many permutation and combination you are giving to your management. It is not only the selling price and cost price. It is not only the selling price and the number of units. It is not only the NPV. You can calculate IRR also. You can calculate the payback period also. You can calculate the discounted payback period also. In all these scenarios. And it is not only the three combination. I increased the combination here. Let me explain you. So, with different scenarios, the kind of, if your 260 per unit and 55,000 units sold, your IRR will be 33% around. The highest. So you can give to your management two kind of options. What are the two options here? Either you can make this as an option, you can make this as an option, that is, or this as an option. You can say with 50,000 unit, make the selling price 275. Your return will be 32%. Or this can be an option, 39, 40%. This will be the highest generating kind of thing, 39 or 40%. And avoid these scenarios 19, 13, 19. If you make your selling price to 75 and sell 55,000 unit, give incentive to your sales team. Tell them increase only 10% increase. 50,000 make it 55,000. Sales increased by only 10%. But your IRR increased by, see how much percentage? 26%, 27% become 40%. Means 13% you increased. 25% you increased the IRR. So go ahead, tell your management, tell your sales team to increase the sales 10%. And tell your sales team to increase the selling price 260 to 275, 15 reals, which is not even 10%. Selling price increased by maybe 5%, sales increased by 10%, your IRR increased by 25%. Again, go to the NPV, for example. NPV, all these things will be changed once you change the data for NPV. You see, I'll change now NPV. All NPVs came because we changed the percentage, so it is showing. Let me go to the number format. So like this, now what I have done for your understanding now, not 3, I changed the sales price 260 original. What if 300? What if 340? What if 220? What if 180? What if 140? Because different scenario. Now the friend who asked the question, you're a manager, you go on. You can 100. What if it is 100? Go on increasing. And here 50,000 original. What if 40? What if 30? What is 60? What is 80? What is 100? What is 120,000? Simple. All this data clear. And here, if you want NPV, go there, click the NPV, enter, and select the range of data you want to fill. Go to the data, row input what you want to change. In the row, you want to change the selling price. And in the column, what you want to sell the number of unit to be sold. Okay. See, all this data came now. The same we will format and put it here. Okay. So, and same formatting we'll put it here. So, and here basically what I have changed, I changed the selling price and number of unit. You can change the cost price, you can change the variable cost, you can change the fixed cost, everything. And here is the break-even point is being calculated. So everything can be calculated. Many scenarios you can provide to your management for calculating the NPV and IRR, payback period, discounted payback period, profitability index. And the more clear you go and the more scenarios you provide, the clear it is to the management whether to go by this decision or not. You said the price will be somewhere to 60, but it may be more less than that. It may be more than that. You said the number of units 50,000. It might be anything. You said your vendor will charge your vendor will charge how much? Your vendor will charge you 110. He may charge 100, 90. Bargain. He may charge even some 150 because of bad scenario. So what if the implication of that? And accordingly the options will come. What will be the option? Either real option, that is the right but not the obligation to take a particular business action, because you have shown all good things to the management, but the management's real option is it's okay, but let us they will not go by that decision action. Then it's a real option to delay. Sometime you might feel it's good, but the scenario is not good, the time is not good, you will delay. Real option, either you go by or not, because if it is profitable, you go by or not. Go by the actual output. Option to delay, in a bad market condition, in a recession time, you might delay. Though it is profitable, let us wait and watch. Option to expand. If it is really good, let us go for expansion. Option to abandon. The project is really killing your profit, your bottom line. So you can abandon that. Markers and just a minute. Let me stop the recording.